Hello and welcome to A Stitch in Tax Saves Cash. I'm Olatunji Abdulrazak, and today we're diving deep into a crucial topic for anyone doing business in Nigeria: how partnerships and joint ventures are taxed under the new Nigeria Tax Act 2025. Partnerships and joint ventures are fantastic ways for companies to team up, share resources, and tackle big projects without creating a whole new company. But this collaboration often leads to a big question: how is the money made from these arrangements taxed, especially when international companies are involved? The Nigeria Tax Act 2025, specifically Section 11, brings much-needed clarity. It ensures that profits from these ventures don't slip through the cracks. So, let's break down exactly what this means for your business. First, let's talk about the core principle. Section 11, subsection 1, is very clear. When two or more companies form a partnership or joint venture in Nigeria, any profit they make is considered taxable income. But here's the important part: the partnership itself doesn't pay the tax. Instead, the law treats it as a tax-transparent vehicle. This means the tax liability flows through to the individual partners. Each company is taxed separately on its share of the profit. This is quite different from an incorporated company, which is taxed as a single entity. For partnerships, your tax bill is based on your specific slice of the pie, as defined in your partnership agreement. Let me give you a simple example to illustrate this. Imagine Company A and Company B start a joint venture. In their first year, they make a profit of 100 million naira. Their agreement states that profits are split 60-40, with Company A getting the larger share. Under the NTA 2025, the tax authority won't send a bill to the joint venture for the full 100 million. Instead, Company A will be assessed tax on its 60 million naira share, and Company B will be assessed on its 40 million naira share. This individual assessment makes things straightforward and ensures each partner is only responsible for their portion of the income. It highlights just how critical a clear, well-drafted partnership agreement is. Your agreement doesn't just define your business relationship, it directly impacts your tax obligations. Now, what happens when one of the partners isn't a Nigerian company? This is a common scenario in today's global economy, and the Act has it covered. Section 11, subsection 2, extends Nigeria's tax jurisdiction to non-resident companies that are part of a Nigerian partnership or joint venture. If a foreign company partners with a Nigerian entity and earns a share of the profit from activities within Nigeria, that share of the profit is taxable in Nigeria. This rule is built on the source principle, fundamental concept in international tax. It simply means that if the income is generated from Nigerian operations, Nigeria has the right to tax it, regardless of where the partner company is registered or based. This provision is a powerful tool to prevent profits from being moved out of the country without being taxed, ensuring that foreign companies contributing to and benefiting from the Nigerian economy also contribute to its tax revenue. The NTA 2025 also introduces a very interesting rule for Nigerian companies that venture abroad. What if your Nigerian company joins a partnership that operates outside of Nigeria? Section 11, subsection 3, addresses this. It mandates that a Nigerian company must report its share of the revenue, costs, and profits from any foreign partnership as part of its total assessable profits back home in Nigeria. This is a significant anti-avoidance measure. It prevents Nigerian companies from using offshore partnerships to hide profits from the Nigerian tax authorities. To ensure full transparency, the law also requires the company to provide the tax authorities with all the details on how these figures were calculated. The company must also apply the relevant adjustments for deductions and allowances as permitted under Chapter 2 of the Act. So, while your company can expand globally through partnerships, its worldwide income attributable to it must be declared and taxed in Nigeria, subject to the rules of Nigerian tax law. Of course, with any general rule, there are often exceptions. The NTA 2025 provides a very specific one in Section 11, subsection 4. These partnership taxation rules do not apply to any partnership or joint venture engaged in petroleum operations. The oil and gas sector is a unique and vital part of Nigeria's economy, and it's governed by its own specialized tax regime. These activities fall under Chapter 3 of the Act, which deals with the petroleum profits tax. This separate framework has its own rules for everything: cost recovery, capital allowances, and significantly higher tax rates that reflect the nature of the industry. Carving out this exception avoids any confusion or conflict and ensures that the highly specialized fiscal rules for oil and gas remain distinct from the general rules that apply to other sectors of the economy. So, let's step back and look at the bigger picture. What are the broader implications of Section 11? First and foremost, it champions transparency. By treating partnerships as tax transparent, the law makes it crystal clear who is liable for what, removing ambiguity. Second, it aligns Nigeria with global best practices, asserting the right to tax non-resident partners earning income from Nigeria is consistent with international tax standards. Third, it acts as a strong anti-avoidance tool. By requiring Nigerian companies to report their earnings from offshore partnerships, it helps prevent profit shifting and tax evasion. And finally, it provides sectoral clarity. The clear exclusion of petroleum operations ensures that every business knows exactly which tax regime applies to them, preventing legal and administrative confusion. In conclusion, Section 11 of the Nigeria Tax Act, 2025, is a well-designed piece of legislation. It successfully balances the need to encourage business collaboration through partnerships with the crucial goal of protecting Nigeria's tax base. The law makes it clear that whether you are a resident or non-resident company, using a partnership structure does not give you a free pass on your tax obligations in Nigeria. For any business operating through a partnership or joint venture, the key takeaways are simple: maintain meticulous documentation, have a crystal clear profit-sharing agreement, and be diligent with your reporting requirements. Following these steps will help you stay compliant, avoid disputes with the tax authorities, and navigate the Nigerian business landscape with confidence. Thank you so much for watching. Hope this breakdown was helpful. If you found this video valuable, please give it a thumbs up, subscribe to A Stitch in Tax, Saves Cash for more insights, and hit the notification bell so you never miss an update. See you in the next video.